and we'll get the first rates, which will start to come up on our screens. And we'll talk about stocks. What do we have? The Nifty starting very tentative, very tentative. 21,982 is where the Nifty is at. 72,400 plus is where the sensex is at right now. So it's a 40-point start on the Nifty higher and about a 90-point start higher on the sensex. So first a couple of hours is going to be a little tentative with everyone kind of watching what's happening and before things settle down. Mid-cap index is up 1/3%. The small-cap index is up as well, about 1/4%. Those two areas, of course, have seen, have had it worse as compared to the Nifty over the last 4-5 trading sessions now. Yesterday as well, both these indices were down about 2% each. But that's the indices. But stocks is where most of the action is always there. Sonia's got those rates. Sonia.
Well, thanks a lot for that, Prashant. I think the important number to look at is here, right? The BSE advanced decline ratio. Now, for now, it's looking good. It's not too bad. So there are almost 1,000 stocks on the advancing side, which indicates that perhaps today we are heading for a stable day, but it may be too soon to call. At least the initial tick indicates that it's not such a bad opening for the market. So as you can see, still below the 22,000 mark, but hanging on without any cut this morning. Let's get straight to individual stocks. I'm interested to see what's happening with SBI this morning because as we've been telling you, a lot of brokerages coming in and raising their target prices on SBI. So up almost 1%. Nomura has a target price of 1,000 rupees. Morgan Stanley has a target price of 800. SBI has crossed that. But in general, the mood is good on SBI. In the broader markets, Escorts is something I'm looking at. Now, the commentary of the management was quite muted. The revenues were also under pressure. But there is some recovery that Escorts is seeing this morning. Interesting here, up almost 2.5%. Some of the numbers that came in post-market hours, I'm looking at BPCL this morning, 4.5% higher. Q4 was largely in line with estimates. The EBITDA actually rose 50% and the margins were up 250 basis points quarter on quarter. So BPCL really shining through this morning. Apart from that, Max Financial is up about 1.5%. The April total APE went up 35% and the retail APE was up almost 32%. So looking pretty good on Max Financials. Now, SRF is the one that I think a lot of people on the street are watching, but the stock is not doing anything this morning. The FY25 chemical business growth is seen at 20% and the margins at 26 to 27%. Apart from that, Abbott, let's look at that, 2.5% higher. Revenues are up 7%. Margins have risen 100 basis points year on year. LIC is the other one. The April premium has gone up about 113%. And the total APE has risen 31%. Retail annual premium equivalent is up 18%. So good numbers coming in from LIC. That stock is well in the green. Now, Brigade Enterprises has been in the news for the last many days. They're developing several projects, a new residential project in Bengaluru. The sales value is 660 crores, so look at that. Today, two big numbers from the auto space coming in post-market hours. There's Tata Motors, expected to be a strong set because JLR was pretty good this quarter in terms of volume growth. And there's also Eicher Motors, not great numbers because there's been a bit of a slowdown in the commercial vehicle piece. Apart from that, I'm also looking out for Mahanagar Gas. Let's get that stock up for you. The volumes were below estimates. The margins fell quarter on quarter, so the street doesn't like those numbers too much. Asian Paints, as we've been telling you, the numbers were weak. The stock was down 5% post numbers, and a lot of brokerages coming out with views. Jefferies says the Q4 was an all-round miss, so the street doesn't like that. In any case, Asian Paints has been underperforming for a while. But let's get back to the headline index, which everyone is tracking now. Still quite steady state actually on the Nifty, up about 50 odd points, as you can see, holding on to the 22,000 mark. But the day is long, so let's see which way things go. Back to you.
All right, Sonia, thanks a lot for that. Well, tech is under some pressure today. Infosys is down close to around 1.5%. I'm just looking at global news. Overnight, you had IPAM that came out with its set of numbers, and they have given another guidance cut on sluggish recovery. So Infosys is down close to around 1.5%, maybe some part of some kind of a rub-off based on what IPAM had to say. But the stock that's getting clobbered this morning is Intellect Design. It's down 14%. I was just looking at it on a sequential basis. The revenues have degrown, margins have improved a little bit, but the street has not taken it too kindly. Remember, these are one of the stocks that have done very, very well in the recent past, and valuations as well were not very supportive. So on the back of weak numbers, not too much comfort on valuations, the stock is down close to around 14%. Sharp downtick out there. Persistent Systems as well down close to around 2.5%. What's doing well then? Well, a couple of good earnings reactions we've got. Suryoday Small Finance Bank, that's up close to around 2%. Manappuram Finance got slammed yesterday. The management came out with a clarification as well. So from the lows, it's seen a bit of a bounce. It's up close to around 2.5% odd. A few more notable movers in trade today. UCO Bank is down close to around 1%. That's one of the top volume movers in trade today. The stock of the morning has to be BPCL. That's up 3.5% odd. ITC is putting on some weight, up close to around 1.5%, while the tech pack is seeing a bit of a decline. Infosys is down. You have LTI Mindtree as well from the Nifty pack, both of them under some pressure. And SPI, stock is still holding in the green. The numbers look good. The stock has already run up considerably, 28% in this year so far, but it's still holding mildly in the green. And as we did that market check, Prashant, the markets almost moved into the red. The Nifty Bank, the swing factor of the day, can it stop this decline that we have seen in the last few sessions? 5% from the top. Prashant.
You know, Nigel, once after a day like yesterday, once you will get, in the morning you will get a swing and maybe a test of the low. But then after that, can we find some stability? That is the point we'll have to see. 21,950 is where the Nifty is at. So just as we speak, we're in the, it's blinking red and green. The normal kind of day would be nice as we go into the weekend. Now, we got, 1,200 stocks higher, 800 stocks lower. That is the advanced decline ratio. BPCL is the biggest volume-led gainer with a 3.33% pop. LIC is coming out of nowhere, 1.5% gain, 916 on LIC, and it's got huge volumes right now. There's something like a Jupiter wagon, small name, but volumes are third largest across, 3% higher. We had the management with us recently. Manappuram ended about 7% lower. That's gaining 3% down. Actually, it was strange because Muthoot came on the air yesterday, said, well, these new RBI cash disbursement limits and the reiteration of that doesn't really impact them. Muthoot ended flat and Manappuram ended down 7. So Manappuram is up a little bit, so maybe making up for that. Escorts is up about 3%. Sonia mentioned that. Paytm is up about 2%. Moil is up 3%. Castrol starts about 4% higher, 195-ish. CAMS is up about 2.25%. We'll be speaking with the management of CAMS in a bit from now. So this is, some of what is going on across the board. I think we, of course, mentioned Intellect. Maybe look at Elecon Engineering as well. That's down 7%, and it's got volumes behind it. MGL is down about 2.33%. Sterling Wilson and Solar is down about 3%. And it's just opening up. Kirloskar Oil Engines, of course, had a big move up. So it's seeing a bit of a pullback down about 2.5% or so. So that is the picture. So absolutely flat, quiet. 7 points on the index, 11 points, 21,970 is where we're at. Devina Mehra, founder, chairperson and managing director at First Global, is our market master of the day. She's with us. Devina, good morning. Good to have you with us here. It's always a pleasure. Prashant this side. What's worrying the market at the margin, Devina? I was joking with Mitesh about that. He was talking about the 2/3 probability. But of course, that was in the context of the Nifty. But just wanted your thoughts to begin this conversation with, Devina.
Good morning, Prashant, and a good morning to the viewers as well. We were expecting some volatility in the short term. So if you see my last interview also, that's what I had said, that while we remain positive in the medium term, at that time I'd said in the 2.5 month kind of horizon, we thought there was going to be volatility. So we have been hedged. We were hedged in March. Those hedges expired. We put on the hedges again in April. So on our PMS portfolios, we have been hedged because our system signaled a possible volatility. So we are not really surprised that this sort of thing is happening, and we are positioned for that. But on the other hand, as I said, since we were not negative on a medium-term basis, we have not made any cash calls. We have not gone into cash.
Okay, you've not gone into cash and you haven't taken any cash calls. Interesting. But Devina, which way do you think the market would swing if the incumbent government doesn't come back into power with a major majority? Because that's what the fear is in this market now. Do you think it will have a big impact on the market post-elections?
Even if that happens, I think the impact will be temporary because if you go back for exactly 20 years, 2004, I think was the biggest upset in election history, where the incumbent government was so confident that they actually advanced the elections by 6 months because they were sure they were going to win. And they lost so badly that I think something like 80% of the cabinet ministers lost their seats. And that day, of course, the market crashed. If I'm not mistaken, the index itself reached the circuit and the trading was halted for some time. But the market forgot it in a couple of weeks' time, and that 1 year basis, that was one amongst the best years in market history. So I think we focus too much on election results. The markets have a mind of their own. India has a momentum of its own.
Hi, Devina. Good morning and good to see you. Where people tell me, Nigel, you've not seen 2004. At least the downside, I hope I don't see that kind of, lower circuit and that kind of thing. So, let's look ahead then. Devina, the last time you joined us, you said few sectors that are quite positive on. If I remember correctly, industrials, pharma and auto. Currently, are you still overweight on that space? So will you be looking to buy out there, or have you turned things around?
No, that we just did our quarterly rebalance in April. So things have not changed from there. Industrials and capital goods, just to remind you, we've been overweight since October 2021, whereas most people started talking about it only last year, only in 2023. So over time, we have cut exposure. We have changed the stocks because many of them even doubled and tripled. So we're not as overweight as we used to be, but we are still overweight. But the question, of course, we ask now every quarter is that, is the story over? Till now, our systems have not signaled that the story is over. So we still remain overweight. And you're right, pharma, autos, some construction, those are the other things we have been overweight on. Where we added more recently have been some commodities, metals and cement. Though, I mean, we're not overweight there, but earlier we had very little there, so we've added some there. Most latest addition has been a bank where we still, I mean, banking as a whole, we still remain underweight, but after a bad phase, it's not looking quite so bad anymore. So some of the stocks are beginning to look a little better than they used to. So that would be broadly where we are.
No, got that. Devina, and this is something that my colleague Nimesh is going to talk about a little later on Editors Roundtable in the afternoon, in the evening actually. The fact that we're seeing a lot of coverage starting to come through on sectors which are India manufacturing, defense, for example, right, is one area. But a lot of coverage is now coming after stocks have moved up 8, 10, 15 times, 20 times in some cases, right? So there is that feeling of FOMO. Maybe it was not liquid enough. There are institutional constraints. But now, of course, investors are asking them, well, why don't you have coverage? Tell us more about this. We want to know. And maybe it will be followed by buying. But just what's your sense? And this is true not just for defense, but capital goods, industrials, a lot of areas. The coverage universe for a lot of people is widening. How do you look at this?
I don't pay much attention to what brokerage coverage says, because many of those things have agendas. I mean, I was on that side of the table at one point.
Would you look at that as a bit of a... Would you look at that as a contra indicator, or is that going too far? Because as I said, they're all coming after stocks have run up 10, 20 times.
Yes, exactly. That's the point. See, as I told you, capital goods, industrial machinery, we went overweight in October 2021. For most human beings, whether fund managers or brokerages, there was that overhang that this is a terrible sector, because it was a dog sector from 2009 to 2021, so 12 long years. But because humans carry that story and bias forward, that for a long time, even when things changed for the sector, people still thought it's not a sector worth looking at. And whereas we went overweight, and as I said, most people have jumped in very late. And we evaluate every quarter whether that story is over. As of now, our systems have not signaled, but as I said, we have cut back, but we are still overweight. Just as, I mean, we are now watching IT, that sometime this year, I think that will bottom out and that will give a good buying opportunity. No, we are not overweight currently, but so you always have to do things which data shows. That's why we follow this human plus machine system, so that human biases don't come into the picture. We look at things on a bias-free basis. In 2021 beginning, for example, I think almost the first FMCG stock our systems liked was ITC, which was among our top 5 performers for the next 2 years. But many people discovered it when a lot of the move had already gone.
This human plus machine thing is something all of us need to get used to, right? at least in across most professions. But Devina, I wanted your thoughts on the auto space, not particularly auto, but this whole premiumization theme, right? Because any segment you pick, whether it's travel, you see Interglobe Aviation at a fresh high. Whether it's hotels, you see Indian Hotels at a fresh high. In the premium auto segment, you see M&M at a fresh high. In the premium FMCG segment, you see some of these, say, platform aggregators like Zomato at fresh highs. So this whole premiumization theme is something that's working quite a bit. You think there's more to go on the upside here? And if yes, what are the stocks that you'd like in this space?
You have to go stock by stock and business by business. But if you look at the economy as a whole, clearly that is very much how the economy has panned out. We all saw that in equity report, which showed that now 65% of the wealth of the country is in the top 10%. It used to be 40% not very long ago. I was reading this Rama Bijapurkar's book, Lilliput Land, and one of the things which struck me is that for the lowest 60% and particularly the lowest 20% of the population, incomes have actually come down. From 2016 onward, the trajectory has been down. If you look at the lowest 60% in terms of income, now they make no surplus. So just income minus routine expenditure, not even taking one-time expenditure into account, that number is negative. So they're generating no surplus at all. So that's what is playing out. You will see that in sector after sector, that the entry-level stuff is not doing well, and whereas the high-end is selling, there might even be a waiting list and things like premium SUVs or cars. But 80 crore Indians need free ration. So that tells you how the bulk of the population is doing.
Absolutely. Devina, good to speak with you. Thank you very much for your time. It's a pleasure. And, hope we can have a couple more of these interactions running into the election. And, of course, we'd love to have your reaction on that important day as well. Thank you for joining us.
Thank you.
Well, that's the, look at the market. I just want to make a quick mention of it. It's a nice, decent bounce now. A 90 point. Now, fingers crossed, we should hold this. So 22,050 is where we are at. At the high point, the market started, dipped a little bit. It was flat to slightly lower, and then it's a nice kind of a smooth ride up. So, we'll take that. If this is just a quiet and normal kind of a day, I think it would be lovely to have this Friday morning. But it's too early in the day. Just 15-20 minutes of trade is what we've had. 22,044 for now. But I think we've got our first management on earnings with us. Nigel.
Well, let's get straight to it then. Indian overseas banks, the numbers look quite good. Mr. Ajay Kumar Srivastava, the Chief MD as well as CEO of the company, joins us on the show. Hi, Mr. Srivastava. Good morning and good to see you in. Congratulations on a pretty good showing in the past quarter. Give us a few numbers, though.
Good morning.
Your
Thank you.
Yields seem to have improved massively, and that's what's led the NIMs as well to do quite well. The last time we chatted, you all were talking about 3.15% order of NIMs, but you've done much better than that. So tell us, how did the yields rise so much, and what are the guidance on the NIMs as well going ahead?
Yeah, because for NIM, there are two primary reasons. First is that we have increased our interest income. We have lent mostly to those sectors where yield is more. That is one part. And second thing is that we have been able to maintain our CASA, that low-cost deposit percentage. And in fact, we have improved, if you see, year on year, from 43.74% to 43.90%. So the interest income we have increased, and at the same time, the interest paid expenses that we have reduced by controlling or increasing our CASA. We did not go for high-cost bulk deposits, and a mixture of these two has resulted in improvement in NIM to 3.28. And to reply to your second question, going forward, we intend to maintain at this level around 3.25, 3.30. Going forward, there will be a challenge on margin because deposit is getting costlier day by day. But we have our plans absolutely concretized, and we are implementing it successfully. And we do hope that by the same strategy, we'll be able to maintain it.
Got it. Mr. Srivastava, so you'll maintain your margins around these level itself. I want to understand a little bit about your asset quality. That has improved sharply this time around. What's the guidance for asset quality by the end of FY25? And what were the write-offs that you saw in this quarter?
Yeah, write-off in this quarter was very minimum, around 400 crores against a total recovery of 1,416 crores in this quarter. So the recovery has been, improvement in recovery has been a mix of various strategies like auctions and ARC sales and upgradation. So all these things have yielded result. And the guidance for next year, we are intending to bring it down by at least 100 bips going forward. And we have, last week, we have gone for aggressive ARC sale also. 92 accounts we have put on block amounting to 13,000 crores. And we are getting good response from various ARCs. And I do hope that this will also be, I will say, accomplished successfully. We are going to get a good value out of that.
Okay, all right. Mr. Srivastava, what about the gross NPAs and net NPAs? What is the number you want to guide for? It's improved to 3.1% and 0.57%.
Yeah, gross NPA, as I said, that our plan is to reduce it by 100 bips. So maybe around 2.10 we are intending to close by next financial year. Right. And accordingly, net NPA, we are looking at around 0.25 to 0.30 at the end of the financial year 25.
Okay, all right. So we've got some numbers on margins as well as on asset quality. What about guidance on loan growth as well as deposit growth? Could you give us that? I think you were talking about mid-teens the last time on loan growth.
Yeah, loan growth, if you see over last two financial years, we grew by almost 24% in 22-23. And this year, which has just gone by, we have grown by almost 16%. And going forward also, guidance will be same. We intend to grow at around 13-14% total credit. And we are pretty confident that looking at the demand in the market, we are getting a good amount of payrage also. I think 13-14% it will be easily maintained.
Okay, 13-14% you will be able to maintain. Can you break that up for us? Where are you seeing maximum demand for loans come through from? Is it from the corporate segment? Is it personal loans? And also, you know, you can tell us a little bit about agri loans, rural market, any kind of qualitative data that you can share with us?
Yes, growth is all around. If you look at IOB's portfolio, we are having almost 70% of RAM that you call popularly as retail, agri and MSME. And around 31-32% is corporate credit. And we have grown in all these four parameters in double digit, around 12-13% to 16%, 17%. So uniform growth has been there. There is not any particular sector in which we want to focus more. For us, these four sectors carry equal importance. And depending on the quality of proposals or offers which we are getting, we will take a call depending on all other factors. And overall, we intend to grow in all these four sectors in double digit. And growth will be uniform. If you look at the portfolio, the retail, agri, MSME, all is around 25-26% of the total portfolio. So we want to maintain that level. That spreads the risk and it gives us lots of comfort.
Okay. So you said that the retail, agri, MSME, right, the largest chunk that you operate in. In agri, I want to understand, are you not seeing any slowdown at all? Because certain pockets, like say tractors, for example, small part, but there is a big slowdown that's underway. A lot of the tractor manufacturers are talking about further slowdown in FY25. So in the agri segment, on an average, what has the growth been and any kind of slowdown there?
Yeah, in agri, of course, tractor sector, as you say, the demand has been muted. Of course, we are also observing this over the last 1 year. But there are many other sectors which comprises of the total agri. If you look at, it's not only direct agriculture or these add-ons like tractor, ancillary businesses. There have been many other things also which have been included in as part of agri, like ethanol project, like food processing sectors. There are many other sectors where mid-corporate, mid-level around 50 crores, 100 crores or 200 crores. That type of proposals are also, we are getting good number of proposals we are getting. Ethanol, of course, everyone knows that it is on the priority list of the government. So we are focusing in those areas also so that we can maintain that growth of 15-16% in credit, agriculture credit.
Okay, you've given us most of the numbers, Mr. Srivastava. Final question before we let you go. Will you all be tapping the markets and FPOs on the cards in FY25 first half of the year?
Yes, exactly. We have already taken board approval. We are intending to go to the market. The approval has been to the tune of 5,000 crores. And we intend to go to the market in 3 or 4 tranches. Certain other approvals are under process. And maybe by end of Q2 or Q3, we plan to hit the market.
Thanks a lot for joining in, Mr. Srivastava. Wishing you all the best for the remainder of FY25. Well, as we're having the chat with the management of IOP, the advance decline ratio should come up for you. That's skewed a little bit, and the mid-cap index has moved into the red. So just keep an eye out on that index. For the time being, we'll slip into a short break. You come back, we'll get chatting with the management of Escorts. That's the stock of the morning. The stock is holding up well in the green.
Welcome back. Well, for now, the market is not bad, actually, holding on to the green line. The sensex is up about 800 odd points. It's quiet, and quiet is good after the volatility we've seen in the last few days. So it gives us some time to talk about some numbers. Escorts Kubota was a weak quarter. The revenues actually declined. There was a slowdown in the tractor business. Their construction and railway business were not bad. It was stable for the quarter. But importantly, the management in the conference call gave a very muted guidance for the full year. Bharat Madan, the whole-time director and CFO of Escorts Kubota, joins us now to talk about that. Sir, thanks a lot for joining in. You know, the slowdown in the tractor business is clearly visible. FY24, your tractor volumes were down for the full year by about 7.5%. You said demand in Q1 is expected to be weak. But can you quantify for us, in the first half of the year, how much could your volumes fall?
Hi, good morning, Sonia. So I think we are seeing this weak trend now after the last monsoon. So third quarter also had started showing the signs of decline, and fourth quarter we saw the decline was slightly steeper at almost 18-19%, where the industry went down. So this quarter also we're seeing the softness, even though April was a month which was more or less flattish. 1-2% degrowth was there because the festive season shifted this time to April. So that actually reduced the impact of the drop. But otherwise, the sentiments were not very strong on the market side. And then coupled with the election scenario, I think some demand has been injected. So this quarter we expect, I think it will be a soft quarter for us. So we still expect it to be a single-digit degrowth, which will happen in the industry numbers. So May, June may still see a slow growth. I think going forward, once the monsoon starts, if the pickup is good and distribution starts, maybe the sentiment will start improving. So July, August, maybe more like flattish month. September onwards, we'll see the pickup start happening, if we really see a good monsoon this time.
Okay, so you're saying a single-digit degrowth is what you're expecting in Q1, and the sentiment is still not strong in the tractor market. Got that. So, do you think that with this degrowth, there could be a sort of a compression in margins as well? So far, you've been holding margins at around 10.5 to 11%. I think in this quarter, you saw 11.2% margins. And you did mention there are some cost efficiencies that you're undertaking. But do you reckon that with this kind of a slowdown on the top line, maybe your margins could come to single digits at some point as well in FY25?
No, Sonia, margin-wise, we are not really much worried. We don't expect the margin will come down to single digit now because the margin active have held back, and actually now we'll start getting the benefit of the full price realizations also, and commodity price continue to be soft. So we had given a guidance the margin for tractor will continue to be in 13 to 14% range. We won't see it dipping down to single digit in this quarter or this year.
Mr. Madan, hi, good morning. Prashant here. So just to tie that number in, so last year, FY24, I think you were down 5%. which is better than the industry. You're saying single-digit degrowth this in FY25 as well, for the full year as well?
No. So I said only for the first quarter.
First quarter.
Yeah, because after that, for post-monsoon, we expect the recovery should start happening. So from September.
So low, mid, single-digit growth.
Overall will be low single-digit growth for next year, full year.
Okay. And, so the elections, etc., you mentioned a few factors. How do you assess consumer sentiment as such? If you sort of keep away elections and monsoons are expected to be normal, I mean, how do you sort of assess consumer sentiment in the market right now, Mr. Madan?
I think we've seen some now sentiments have been improving, especially in pockets like Maharashtra. We've seen this time the volumes were good, the Gudi Padwa, so festive season, so we saw good numbers coming in from Maharashtra. And we also improved our market share in Maharashtra. So I think that's a positive sign because the rainfall typically had impacted the southern and western market the most, which is what impacted the industry. So the stronger market in north and central was not really impacted to that extent. So we've seen good traction coming in from markets like Rajasthan, even UP, to some extent, and now Madhya Pradesh. So overall, I think the positivity is there, I think in certain pockets, but wherever the impacts were more because of the patchy monsoon last time, so there we'll see the recovery will start happening now.
All right. Good morning, Mr. Madan, and thanks a lot for joining in. This is Nigel on this side. I had a two-part question. You all had put out a midterm guidance, I think in 2022, towards the end out there. And one of the targets was to double your market share. But as I see, there's not too much movement on the market share. So could you tell us what it is and where is it headed? Point number one. And point number two, on the implements business, you all had guided that you're likely to see that triple. What was the updated number for FY24 on the implements business, which is a smaller part?
Sure. I think to the first question, I think once we had given the midterm business plan, which is based on the consolidated entity. So as you know, there are two joint ventures with Kubota, which will get merged into Escorts now very soon. We're expecting the order to come from NCLT anytime within this quarter. So those two JVs have roughly, they do about 20,000 tractors out sale, and they're also very good in the implement side. And they're doing very good business on the harvester and transplanter, where the volume is almost 300 crores plus. So I think post-merger, we will have a market share of close to 12-13% combined entity, which is what we are looking at doubling. Obviously, one of the reasons is the slight delay in the product introduction and the new product development process. But then the stabilization and integration is taking some time. And when that starts, we'll have all the white spaces filled in, for the new products, which will start coming in, in the market from this year itself, this year end. And then FY26, we'll see the full benefit coming in from those product portfolios. So we'll see probably the moment and the market share will also start happening positively. So fortunately, in the last quarter, I think we've been able to gain 1% market share overall, especially in the stronger market. So which is a positive sign. And we expect with this, I think, new products coming in, that will also really help us post-integration, the merger. Same thing on the implement space, like you mentioned, since the implement is a big business for the JVs and post-consolidation, we expect that will be a good revenue driver for us going forward.
Okay, all right. Mr. Madan, just one more question from my end. In the past, there were some reports that suggested that you could be looking at selling the railway business. Is that on the cards?
No, it's all speculative. Actually, we denied that also to the stock exchanges. So there's no such news. Yes, we know Kubota is not really into the railway business globally. So there's not really a sector where they can add value. But that doesn't mean that it will be sold off. So obviously, we're looking at the right partner who can really help us in doing that business further.
Okay, so you're looking for a right partner to take that business further. Are you looking to tie up with anyone anytime soon in this calendar year? Should we look at any kind of strategic investor coming into the railway business?
So we already have multiple collaborations in that business for different product portfolios. So we're trying to expand that portfolio further now. Given the trending position from the government side, railway business is looking strong and it's showing very good growth, and we expect the similar growth momentum will continue this year too. So obviously it's the most profitable business for us right now.
Okay, so railways is the most profitable business. Got it. The construction business has also grown very well. I just want a number there because in FY24, your volumes went up almost 42% in construction. Is this the kind of pace of growth that you're expecting in FY25 as well? And what is the order visibility that you have in this business?
No, we don't expect the growth will be to the extent of 40-odd% this year. But the industry has already touched a new peak last year. So even if the industry maintains at that level, I think it will be a very good number. We need to continue with. Though we expect some growth will come in, but again, construction industry picks up after the monsoon season. So there again, we see the good growth will pick up actually post-September. Overall, the margin profile in the industry has really turned around. If you look at it, almost a double-digit margin in the last quarter for us. So which is almost touching now, catching up with the tractor business, in terms of margin profile. But it's a focus area for us, and we'll continue to add more products, and expand our portfolio in this segment.
Okay. All right, Mr. Madan, we'll leave it there. Good luck. Thank you very much for your time. PNB is the next company which is on our focus, one of the largest public sector banks, one of the largest banks as such. Well, numbers came in slightly maybe below street expectations. Loan growth came in, I think, about 11%. Margins were flat. Asset quality is improved, though. Mr. Atul Kumar Goel is Managing Director and CEO at the bank. He is joining us now to take some questions. Mr. Goel, good morning, sir. Thank you very much for your time. Prashant this side. Could you talk to us a little bit about what should we expect in terms of loan growth in FY25? Would it be up north of 11%, what you did in the quarter gone by? Just give us a sense, sir. How are things looking?
Yeah, very good morning, Prashant, and welcome to all the viewers of the CNBC-TV18. As far as credit growth is concerned, the guidance for the current financial year is around 11 to 12% also, as against the 11.20% we have achieved in the last year.
Okay, so between 11 and 12% for the full year FY25. What about net interest margins, Mr. Goel?
Net interest margin, we are giving the guidance, it will be more than the 10% for whatever we have achieved in the 23-24, and the same, if you see the last year also, the growth was last quarter on the same line.
No, I meant margins, sir.
Margin as 3.23 was the margin for the domestic, as well as the 3.10 for the global. And last year also we have given the guidance for the 2.923. So same guidance we are continuing for the current financial year.
All right. Good morning, sir, and good to see you. Give us an estimate about recoveries for FY25. Will it come in from NCLT cases or IBC cases?
It will be the mix of the all, because if you see my kitty for the NPA 90,000 rupees, 90,000 crore is the TWO, and 46,000 crore rupees gross NPA. So it will be the mix for all the small as well as the corporate from the NCLT. Last year we have recovered around 3,300 crore from the NCLT. The same number we are expecting in the current year also. Overall guidance for the whole of the year, around 18,000 crore rupees we will recover from the NPA in the 24-25.
Okay, 18,000 crore rupees you'll recover. So what is the gross NPA target by the end of FY25? I didn't get that.
Gross NPA 5.73 we have achieved on the March 24th. So it will be below 5% as far as net is concerned. 0.73 it was in the March 24. It will be below 0.50 by the end of the March 25.
Okay, so gross NPAs you're saying will be below 5% by the end of FY25, currently at 5.73%. So there's further recovery expected. Any fundraising plans that the bank has in FY25?
As far as fundraising concerned, we have already got the approval from the board for 7,500 QIP, 7,000 crore rupees for the 81 and 3,000 crore rupees for the Tier 2. The total plan for the 17,500 crore for the current financial year.
Okay, Mr. Goel, the other big talking point lately has been, of course, this entire bit about project financing and how one has to raise, standard asset provisioning for that. We heard from the SBI chairman after the results, and we've been sort of speaking with others as well. Could you tell us what is the exposure there for PNB? And should we expect any impact whatsoever on any metric if this does indeed go up to 5% in a phased manner?
Prashant, although it is a draft guidelines and the view has been taken from all the stakeholders from the regulator on the till 15th of the June 2024. As far as our bank is concerned, so our total exposure in the infra is the around 92,000 crore, and 50% of that will come under this category. As far as PNB is concerned, there should not be any worry if the final guidelines is coming for making any provision also. That is not an issue at all in the Punjab National Bank, because now our balance sheet is very strong.
So 45,000 crores is exposure to project finance, which gets impacted because of this if it does go up to 5%. But you're saying that there is no impact.
Although RBI is giving the 3 years time for that also, because 5% we are not required to make immediately.
Sure. And that 3 may become even longer. I mean, depending on. We'll have to see the final thing. This is, of course, only draft guidelines, and we'll see what really comes of it. But you're saying there's no impact because of this, right? Even if it goes to 5.
Yeah, whatever the impact will be there on account of the higher provision, as I told you, we will be in a position to provide, and we will pass on the whatever the impact to the credit debtors also. Yeah.
Okay, all right. Final question, sir. Before we let you go, your annualized credit cost, that's come in at the lowest levels in the last 9 years. Could you give us a guidance on that number, point number 1? But your Opex, that's moved higher. I think the cost to income is the highest in 10 quarters. So give us a guidance on both these two numbers, cost to income, as well as if you could give on credit cost.
D'Souza, first I will give the answer of the credit cost. Credit cost, if you see, the last quarter it was 0.80, and for whole of the year it has 1.40. So we are giving the guidelines for the credit cost. It will further go down. It will be less than 1% for the 24-25, because provision coverage ratio is already more than 95%.
Okay. Sir, you gave us your guidance on asset quality, but I didn't get the slippages number. Would you have any sense of which way the slippages are going to go in FY25? What could be the average, slippages per quarter?
Slippage for if you see the last quarter, it was 0.98, and whole of the year it was 0.70%, and we are hopeful it will be less than the 1% in the current financial year.
Okay, it will be less than 1% in FY25, you said, right?
Yeah.
Okay, got it. I had just one more question. We were just speaking with another banker a while back who suggested to us that there is recovery in certain pockets in the rural market as well. But, overall MSME, rural, there are still some pain points. In terms of loan growth, where are the pockets of pain that you're still feeling, which could perhaps lead to muted loan growth going forward?
Loan growth, if you see, the focus area for the bank is the RAM, retail, agri, as well as the MSME also. If you see the growth in the total advances was 11.20%, but growth in the retail was around 15%, and even for the housing it was 14%. The vehicle, there was a growth of around 25%. The growth is also coming from the rural and the tier 2, tier 1 city also.
All right. Mr. Goyal, we'll leave it there. Thank you very much for your time. Appreciate it very much here on CNBC-TV18. I think we'll take a quick commercial break here. But okay, we'll bring in Mitesh. Look at the bounce, right? The bounce is there. It's real. 130, 140 points, 22,090. It's kind of bounced off those levels, 21,930-ish. Not quite there. We didn't quite get there, but... it's a real bounce, and not even 1 hour into trading. So I think maybe a couple of hours, and maybe you can say that, this is holding. Mitesh is with us, though, in terms of what you should do. I mean, as you look at this market. Mitesh, what's your sense? Mitesh, I think you'll have to unmute yourself. Yeah.
My idea remains that the market is bearish and weak, and therefore, we will look at shorting at slightly higher levels. The levels which I prefer, and I think this pullback can possibly play it up to 22,150 to about 22,220. That's the zone which I think the market will face strong supply. So slightly higher, I think around 22,150, we'll want to get into some short position. Now that can be done via directly shorting futures. If you're doing that, then take about 80 odd point kind of a stop. And if you are or you can buy into put spreads, which will give you profitable positions when the markets are slightly negative. So Till we see a closing about 22 to 20, 22 to 30, I'll still maintain a negative bias. Though on stock side, I've maintained FMCG as the buying area, so I have a buy call over there. Godrej Consumer is something, which is sideways for the last 2 days. So buy here with a stop at 1300 for targets of 1400. And Dabur is the other one, which I would recommend buying with a stop just below days low of 540 and look at targets of 570.
Okay, the Godrej Consumer and Dabur, you said, right? A couple of other names that I wanted to check with you. What's your view now on SBI? Do you see further market upside, a fresh buying interest? And some of these life insurance companies are seeing a bit of a pickup at the moment. HDFC Life is seeing some traction as well. Anything that you see here on the charts?
See, SBI, in the entire financial and banking names, SBI has remained an outperformer, and I think it still looks good to me. As long as the stock is above levels of 780, I think decline should be used to buy it over here. But for the life insurance companies, particularly stocks like HDFC Life, ICICI Pru, etc., I think looks like a bounce back from oversold levels. Again, more of a pullback, which should get sold into at slightly higher levels.
Okay, all right. Mitesh, thanks very much for that. Well, we'll take a quick commercial break here. We are back and we'll have the management of CAMS to discuss their fourth quarter numbers. We'll look into F525 as well. Lots of sort of non-mutual fund businesses which CAMS is getting into, and what can that mean for the business? So Anuj Kumar, Managing Director of the company, on the other side.
Welcome back. Well, let's focus on the next management, CAMS. For their quarter four, their margins have improved. Strong equity inflows have aided the mutual fund business, while the cost-to-income ratio has also improved. We're now joined by Mr. Anuj Kumar, the MD of CAMS, who joins us to discuss the past quarter's numbers and the way ahead. Hi, Mr. Kumar. Good morning and congratulations on a good showing. Well, according to your earlier guidance, the non-mutual fund business, you expected it to grow by around 20%. But with these recent new developments, do you expect it to grow at a faster clip? And if you could tell us, what does it mean in terms of margins going ahead?
Hi, good morning. Thanks for having me on the show. Overall, if you see, we had sustained results in the fourth quarter. Non-mutual funds especially, revenue grew 52%. If I keep out the acquisition of Think 360 on a constant base, they grew 38%. Look at it this way, that we've made major investments in building out the platforms for non-mutual fund businesses, especially for account aggregator, TSP, or utility, Bima Central, MF Central, etc. Now we are in the go-to-market stage where we are signing up new customers and we are, scaling volumes and scaling revenue. So overall, this will be margin accretive as the build-out cost of platforms has kind of slowed down. That build-out has happened in FY 22, 23, and 24. And now we will enjoy the benefits of scaling revenue in the same utilities.
Mr. Kumar, hi, good morning. Prashant here. So what will revenues in F25 grow by?
So if you see last year, we grew about 17%, a gross of about 165 crore of revenue addition. If there are no stressful phases in the market, which means markets hold out, I think a repeat of this should be entirely possible, which means expect us to deliver about high teens in revenue and maybe an identical profile in EBITDA growth. So about between 17-18% of revenue growth should be possible this year.
Got that. So high teens, so around what you did, 70% is possible in FY25 as well.
Yes, absolutely.
On the insurance side, where is that? So the IRDAI is mandated policies in electronic form. Has that started? Where is it at? And what do you make on dematerializing these policies?
So what's happening is that there is no explicit guidance for demat of insurance policies. There is explicit guidance on issuance of digital policies, which could also be placing them in the DigiLocker or just sending a PDF with an email. It is not a mandatory step towards demat. That's a different paradigm, which is not happening right now. What is definitely happening is that the new age consumer is beginning to realize the impact of, the benefits of e-insurance accounts. Some of this has kind of kindled interest, the recent announcements, but there is no one-way street to demat in insurance yet. When that happens, I think the scale will be very large. Today, this will lead to just incremental volumes, but not a major transformation in the markets.
Okay, so I just want to get this correct. Between the MF and the non-MF business, what is the kind of growth that you see, not just in FY25, but over the next couple of years? Where will the larger chunk of growth come in from, and what could the numbers be?
We're expecting MF to continue growing about 15%, non-MF to grow in excess of 20%. Like you saw last year, non-MF grew 52%, but that was an exceptional year. When you blend this, you should see us at least in FY25 to grow about 17-18% revenue, maybe an identical profile in profits. That is something that I can see happening because the base effect is anyways playing out, which means the significant increase quarter on quarter in FY24 will continue playing out as a benefit to us. So that is something we definitely believe will happen in the coming year.
Okay, so high teens growth is what you're looking at. I want to also ask you about the investments that you plan to make in your non-MF business. How much will the quarterly run rate be? Because you do have cash on your books as well to the tune of around 620 crores. How do you plan to utilize that? Any kind of inorganic growth opportunities that you're looking at?
So in terms of inorganic growth, we had made two investments in the last 2 years. The first was a small outfit called Fentuple Technologies. Last year, April, we signed up with Think360 to buy majority and control in them. So we continue to look for opportunities. These will be in the B2B space. We are keenly watching both insurance and payments and anything that we can do in the alternative space. So we could make an announcement during the year. There's nothing definitive yet. But yes, from a cash position, we are in a strong place. We do dividend out about 65% of our profits, but we're carrying over 600 crores in the group, in the main company and across subsidiaries, which can be used to fund acquisitions as and when we are able to identify a target.
All right, Mr. Kumar, final question then before we let you go. The non-MF business is likely to grow at a faster clip. Could you tell us what does it mean on margins, point number one, and the cost to income ratio? What's the guidance?
So overall on margins, we have stated that we will be able to grow EBITDA margins by about 1% a year. I think the last quarter was an exceptional quarter where we grew EBITDA to about 46%. I think in the next ensuing 2 quarters, you should expect it to be between 45 to 46. And therefore, from a cost perspective, about 54-55% of revenue gets costed out. Expect that to happen over the next 2 quarters.
All right, Mr. Kumar, appreciate you joining in. Wishing you all the best out there. For the time being, the stock is holding in the green. As you said, high teens growth and margins at around 46% could be a one-off. Expected to trend a little bit lower in the time to come. Stock up 3%. Well, let's turn our attention away from the equity markets to the commodity markets. Manisha Gupta joins us to tell us what's going on there. Manisha.
Thank you for that, Nigel. Well, my eyes are on gold today because one, it is Akshaya Tritiya, and two, we've seen a very smart rebound over the night in case of the commodity there. So the prices are trading nearly a percentage point higher on the overnight markets and nearly 0.5% up at this point in time as well. Well, there are renewed rate cut bets, and that is what is supporting the gold prices. We are more than 2% up for this week itself. The Bank of England has signaled a cut coming in as early as this summer, and the US jobless claims, the data that came in yesterday, also suggests that you could be looking at a rate cut coming forward in September. The jobless claims was the highest in 8 months. The markets will watch out for the US CPI and PPI data. Well, that comes in the next week, and that would give you further direction also. But the strong OTC demand, the Asian demand that the markets are looking at has been quite supportive there. Also, the markets are betting on a 69% chance that the September will bring in first rate cut from the US Fed. That has been supportive. If you look at the central bank buying, that has been on the stronger side as well. And I should show you those numbers, because 2022 was a record buying from central banks at 1,082 tons of gold. Last year was a second record high at 1,037. In the first quarter of 2024, the central banks have bought 290 tons gold already, and the markets do believe that 1,000 is a level that you could see crossing by the central banks in this year as well. If you look at the Indian buying as well, the estimates are that 700 to 800 tons of gold consumption that India sees on an average would be seen in this year as well. This is what we've done in sense of prices on every Akshaya Tritiya. So if you bought gold in 2020, the gold prices were at 46.599. But the important price trends really come in the last 3 years itself. If you bought gold in last couple of years, you are looking at double-digit percentage growth in sense of gold prices. So 2022, gold prices were at around 50,000. Last year, same time, Akshaya Tritiya, it was at 60,000. Today, the 22-carat prices in the physical markets is trading at 73,000. So when you look at the last 3 years in sense of price moves, we have seen very strong gains come in for the gold prices there, with the expectation that you're looking at higher prices from here on as well. In the international markets, we are trading at $23.50 an ounce, with expectations that $2,500, $2,700 is where you could be headed. That would mean further higher highs for the Indian markets going forward.
Okay, all right. Manisha, thanks a lot for that. And I always take your advice for the last few years. I'll be buying some gold even today, Manisha. Thanks a lot for giving us that update and for the advice as well. Well, for the time, we'll slip into a short break. On the other side, we'll get chatting with the management of Larsen & Toubro. You don't want to miss this. Stay with us. Welcome back. Well, the big cue today has to be the Nifty Bank. That's been under pressure for the last 7 sessions. Or it's been seeing a lot of selling. It's down close to around 5% from the peak. Now, that's coming into form. That's up close to around 0.6%. And that's going to be the swing factor today. If the Nifty Bank can continue to build on to these gains, then it'll be pretty good news. For the time being, it's holding above the 50 DMA. The 20 DMA is around 400 points away from current level. So that's one stock that we're looking at. The other one I'm looking at is Thyrocare. Just take a look at the massive volumes we've seen. Even yesterday, late in the session, we did see some volume spike up. But in the first hour of trade itself, we've seen more than 6 lakh shares getting traded out there and fairly volatile moves, as that chart is telling you. So keep an eye out on that stock, up closer around 4%. A few other notable names from the broader markets. IOB, we had a chat with the management. They sounded confident with regard to growth, asset quality, as well as NIMs. For the time being, IOB is up. It was trading in the red. It's moved to the high point of the day. And NHBC is another stock that was trading in the red. That as well, Prashant, has done a bit of a U-turn. So good start, a good first hour of trade. The bulls will like to maintain this sort of a pace and hold on to these gains. Let's see if that's possible.
Absolutely, Nigel. And, this is a nice bounce. I mean, I don't know if we can have that sort of Nifty chart. Okay, I think we'll have that up a little later. But the big talking point, of course, also has been the L&T results. The stock was down sharply yesterday. And the disappointment largely is on the margin bit. Otherwise, I mean, it's been a pretty healthy sort of set of numbers which we've seen across the board from the infra major. The company's guided for a 10% growth in order inflow in FY25 on what was already a very elevated base. Mr. R. Shankar Raman is President, Whole-Time Director and CFO at Larsen & Toubro. Mr. Raman, thank you very much for your time. Great to have you with us here. Thank you for joining us. Prashant, this side. Margins is what I guess everyone is very focused on, and we'll come to that. But I just want to start by talking about the pipeline, right? Essentially, my question is to you about what we are hearing from Saudi Arabia in terms of, their spends on infrastructure being lowered, be it Aramco, be it that new city which was to come up. And these are sort of public statements we've heard. You've, sir, in commentary, essentially said that your pipeline is very, very strong for orders. FY25 pipeline is about $146 billion. That's up 24% year on year. In 24, this number was 14% higher. Have you factored in any sort of disturbance which comes from Saudi, or is it inclusive of this? Can this number reduce pretty dramatically as we go through the rest of the year? What are you seeing?
Good morning, Prashant. Good morning, viewers. Thank you for having me on the show. I think the way we look at pipeline is looking at all the prospects that the clients are working on. The time factor that it takes for some of these to actually convert into specific programs, thereafter to RFPs and thereafter to awards, is a pretty long one in particularly project business. So the first sign that we look at is how consistent and strong is the pipeline. And when we look at it from that perspective, 12 lakh crore or close to $150 billion worth of opportunities are looking available for investments to be made, both in India and Middle East. Stepping back a bit on this pipeline, I think since we have 60% of our business coming in from India and 40%, we have to constantly keep looking at both the opportunities, because the sizes of these opportunities are different and the resources that needs to be engaged in these opportunities are also vastly different. So considering that, we need to balance between our resources as well as our plans and growth aspirations. We constantly look at both and try to see where we can scale up. The advantage with Middle East so far has been that they've been investing in oil and gas. The geopolitical tensions, the frozen wars in Europe, etc., has led to a situation where pumping out more oil and gas energy continues to be profitable for the Middle Eastern companies. Oil at around $80 and thereabouts seems to be a fairly sweet spot for them to be able to cater to the global demand as well as generate resources for them to build their economies in a more broad-based fashion. There is a very stark realization over the last 5-7 years in these markets about the need to develop their business from a one-pony trick to a much larger economic engagement. The people are getting educated. People in Middle East needs to find profitable vacation. And consequently, the development of Middle East started towards, instead of a one city region of Dubai hogging all the limelight, we are now having alternate cities coming up. One is existing infrastructure getting strengthened. Middle East always was known for excellent roadways, but they did not really spend much time and energy or money in developing rail network. The cities were far flung, so possibly they didn't have the compulsion. Now, as you can see, if you travel there, Dubai and Abu Dhabi is almost connected by various development along the way. So it looks like one continuous stretch now as compared to what it was a few years ago. Now, given this development and the migration of people wanting to live there, because the social conditions in those regions are also improving. So if you look at Middle East from a holistic point of view, oil and gas will continue to be the fund provider for many of their efforts. The transition that they have done for solar is remarkable. We ourselves as a company are working on 18 gigawatts of solar power, and we're the single largest contractor out of India working in Middle East on this area. Given that trust that they have, because they have enough and more land, they have enough and more sun. So it's actually a no-brainer that solar capacity will come there thick and fast.
Mr. Shankaraman, since we... I don't know, fantastic points and a really comprehensive explanation about what's happening there, and that trend will continue. But, could you tell us what is your exposure from the Middle East? What's the exposure in terms of order booking from Saudi? If you can give us those two numbers. And as of now, you're not hearing anything, not just for you, but for others in the market, because you'd hear what's happening. No cancellations, no ram downs, nothing.
Yeah, we have totally the order book is about 4,75,000 crores, and we have almost 1,80,000 crores in the international markets. 80% of this order book is from Middle East, and within that 80%, almost 70%, 72% is Saudi. So Saudi dominates the order book. We have close to 1 lakh crore out of just that market in Saudi, and over Middle East it'll be maybe 1,25,000 crores. So that's the size of the pie that we have. These are orders that we have got in the bag, and this excludes the bids that we are evaluating for submission going forward. There would be a pause in terms of reallocation, because I think the sectors to which they want to reallocate capital, we've seen announcements, particularly from Saudi Aramco. But on a $60 billion per annum base of investments that they're talking about, a 10 billion shift is what they're talking about, 40 billion in 4 years. A 10 billion shift, according to me, is not going to upset our plans for Middle East, given our size and scope of engagement.
All right. Hi, good morning, Mr. Shankaraman, and good to see you in. This is Nigel on this side. What about the core margins? The street seemed a little bit disappointed with the guidance you've given out there. Do you think that you're being a little bit conservative on the guidance you've given? And is there an upside risk? And tell us why you're being so conservative.
We need to understand this margin business a bit. I know the street is not very happy by seeing a number at 8.2% that we have reported for the core. The portfolio as a whole has reported 10.6%, but you leave aside the services business and you just talk about projects and manufacturing business, we have printed 8.2%. And this was 8.6% last year. Last year, when we printed 8.6%, we were committing our resources towards earning this margin, almost 18-19% of our revenues. The 8.2% that we have reported for FY24 has 12% of revenue committed as resources. Now, in terms of this value creation, margin is one piece. The other lever is capital employed. How much capital do you employ to earn the money is a most important aspect in this. And what the street possibly has missed out is that the capital efficiency that we have packed in rather very well in FY24, we seem to have sort of lost sight of it. Secondly, the changing mix definitely has a role in all of this. Earlier, we used to be 20%, 22% of our order book used to be international. Today, it's 40%. What this means is the size of the projects goes up, so scale is high. Secondly, the absolute margin in Middle Eastern contracts are lower than Indian contracts. But the cash terms that are available, the payment terms, the milestone payments, the front-ending of cash flows are much stronger in Middle East. Now, given that the changing mix of international domestic order, it is to be expected that the 9%, 9.5% we used to print as margins when we are only focusing on India, essentially, will change. The point that is to be appreciated is is that changing without any change in capital employed, or is it changing in tandem with capital employed? If I context it that way and look at the performance of the company, I think the value we have generated is reflected by 200 basis points improvement in ROCE and almost 270 basis points improvement in ROE. Now, we do believe we have created value for shareholders through the FY24 performance, and we'll continue to do that going forward. The margin and the capital employed are two levers which are dynamic, which will keep moving depending on the type of contract, the geography, etc. So my advice would be not to unduly lose sleep over the margin, but look at the overall value creation efficiency that we are demonstrating. But having said that, the company is committed and will do everything possible within our means to make sure that the margin improves to better levels, even during FY25. But given the fact we are almost looking at a 7-month or an 8-month year ahead, we thought that it may not be prudent for us to upscale this now, and maybe we'll reserve some good news for FY25, 26.
Okay, no, but take your point. So it's a balance, as you put it. So just focusing on that one number may perhaps not be the right way to do it, and perhaps the market will take note of that as well. Because of the elections this time around, briefly, Mr. Shankaraman, I had a few more questions. Is there any impact you're already starting to see, or not really?
In terms of the bids that we have submitted, the opening has got delayed. Obviously, I think once a code of conduct is announced, there is an inevitable slowdown, and that was actually anticipated, and this is the reason why we almost did 75% or 80% of what we need to do for the year by December. And we could then enter the last quarter with not so much of stress of having to meet the target. We well exceeded the target. Now, during the months that we are seeing now, and maybe right up to the election results, I don't expect these bids to be opened. So it's going to be more of focusing on executing. And as elections are happening, I think all our contract workforce are also getting scattered because they are all going back to their villages to cast their vote and whatever. So to that extent, there's going to be a bit of a reassembling of workforce. So from July or June end, our execution will start gathering pace to come to normal. In terms of fresh orders, I think the first phase would be to open up the bids that have been submitted. If there is continuity in the government and its policies, these bids would be opened and then awarded. If there's going to be a discontinuity, which I don't know how things will pan out, then there's going to be a question of what happens to these bids. Are they going to be cancelled, resubmitted, etc.? So there is an inevitable interruption that this event of national importance will throw up. And hence, we are thinking that for fresh orders to come in, it could be more from August, September. So it looks like a second half heavy year going forward, and which is largely the reason why we also scaled down the growth to about 10%. Not to say prospects are dimmer. It's just that ability, the time that is taking to convert all of this into specific orders could take all the time up to March 25.
Okay, maybe I can got that, sir. So it's like an H2 heavy kind of year. Two more questions. How are ridership trends in the Hyderabad Metro? Is it on track for divestment? There is one. And can we expect a buyback next year given the strong cash generation overall from the company?
As far as Hyderabad Metro is concerned, I think FY23 we closed there with average ridership of about 3.2 lakh per day, and the ridership has improved to 4.6 lakh per day as we closed FY24. In the month of April, we have seen about 4.7, 4.75 lakh per day ridership. I think it is very important that in the space of public-private partnership, the public policies have to actually take into account the private capital commitments. We had a new government in the state of Telangana, and one of the poll promises, which seems to have been implemented right away, was free bus passes to women of all age. Now, that shifted close to 40,000 people who were traveling in metro into the buses, because I think a free bus ride, free lunch, everybody prefers. But what it is also doing is pushing some of the men folk who are finding the buses very crowded back to metro. So we think that there'll be a shift, and some amount of gender diversity will not happen in the ridership. It will be a little more male oriented. So we guess we'll get this traffic with some lead lag. We should be able to get this 5 lakh people back on the metro. Secondly, I think Hyderabad does have a lot of IT professionals working and using the metro. The return to work is still not complete. People are still working from their homes, etc. To that extent, the ridership is punching below its potential. It has potential to have another 50,000, 70,000 people traveling if the IT crowd really comes back to office. And the third part of it is we have about 18.5 million square feet of real estate attached to the metro. We've got approval for monetizing a few bits of that, which we did in FY24. Approval is pending for a few more bits in FY25. And the state also has granted a soft loan, long-term interest-free soft loan of 3,000 crores, of which we have drawn 900 crores. We need to draw the balance 2,100 crore. So a bit of improved ridership, bit of monetization, and a bit of time crunching in terms of getting the soft loan